Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome to the deep dive.
Hello.
Our focus today is a rigorous distillation of the latest strategic views from UBS Global Research.
That's right.
We're looking at the report titled 2026 Outlook Part 2, Style, Themes, and Sectors, which was published on December 16th, 2025.
And our mission here is to really help you navigate this material. We're going to try and differentiate between their short-term tactical calls and, the longer-term structural conviction plays.
So what's the headline? What's the overall stance from UBS?
Well, I'd say it's a stance of guarded optimism. They're actually expecting upside surprises to global GDP, forecasting 3.1% global growth for 2026.
Which is only a slight step down from 3.3% in 2025. That feels pretty constructive, actually.
It is, especially in the context of all the persistent inflation fears we've seen. It's a fairly positive picture.
But the core message isn't just buy everything, is it? It feels much more nuanced.
Not at all. It's selection over aggregation. They point to stretched valuations in many cyclical sectors, so the overall recommendation really leans towards selective defensiveness.
A classic barbell approach, then.
Precisely. And the macro backdrop reinforces that need for caution. Tactically, for instance, they see the dollar as bearish in the first quarter of 2026.
That's an important near-term call.
A very important one for global asset allocators. And then looking a bit further out, they see bond yields rising later in the year. The German bond yield, for example, is forecast to end 2026 at 3%.
And that rising yield has a direct impact on certain sectors, right? I'm thinking European financials.
Exactly. It's quite constructive for them, and we'll definitely circle back to that.
Okay, let's jump straight into what is really the defining theme of this cycle, technology and generative AI.
Right.
UBS is still overweight, but their positioning seems highly targeted.
It is. They're focused on 4 core top-down holdings: Microsoft, Amazon, TSMC, and Tencent. And then, interestingly, they also have a tactical recommendation on SAP.
In this conviction, it's not just about the hype, it's rooted in the numbers.
It's absolutely rooted in the earnings projections. I mean, earnings growth for what they call the Tech Plus universe is forecast to be better than non-tech all the way out until the second quarter of 2027.
And what I found fascinating was the valuation defense.
Yes.
Despite this massive run we've seen, the PE relative of the Mag 6 is actually at the low end of its post-2018 range.
That is a critical finding.
Yeah.
It really implies that institutional positioning is far from euphoric.
So not a bubble.
They're arguing this isn't a bubble phase. It's more of a structural realignment where quality and scale just command a sustainable premium. So the market's sending them a premium, yes, but it's been higher in the past.
So that confidence leads them to double down on the memory cycle.
It does. They believe the memory cycle could be a once-in-a-decade year in 2026.
And the numbers driving that call are, frankly, staggering. It all comes down to the hyperscalers.
Yes, the Amazons and Microsofts of the world. They're demanding 100% more DDR bits, that's the standard for DRAM memory, than they did in 2025. 100%.
That supply-demand imbalance is huge. So what does that do to prices?
It leads UBS to forecast a roughly 40% price rise for DDR memory by the middle of 2026.
And that flows directly to the component makers.
Directly. TSMC is one of their favorite names. It's buy-rated, and they note it has a dominant technological lead, something like 5 years ahead of Chinese rivals.
In ASML?
ASML is the other key beneficiary. They make the machines that make the chips. They're already getting 15 to 20% of their revenue from Gen AI.
Okay, we focus a lot on the winners. Let's pivot to the other side of that. The risks, the potential losers.
A necessary counterpoint, yes. There are major concerns around capital intensity and margin sustainability, even for the winners.
Right, so how close are these hyperscalers to actually hitting a cash flow crunch?
Well, the report flags that their CapEx relative to sales is rising sharply. Now, in aggregate, the top 11 can still fund CapEx out of their operating cash flow.
But the trend is the concern.
Exactly. The stress test shows the risk. Their CapEx would have to rise nearly 70% above their forecast 2026 operating cash flow to breach that threshold. So safe today, but it's a trend to watch.
And what about margins? The report specifically calls out NVIDIA's 52% net profit margin as unlikely to be sustainable.
Yes, and that's a critical point. It's a risk caveat that informs their underweight positions in sectors that are vulnerable to AI disruption.
So AI isn't a tide that lifts all boats.
Not at all. The list of potential losers where UBS is generally underweight is very instructive. You have employment agencies, sells on Adecco and Randstad Creative Media like WPP and ITV.
And even office property.
Yes, office property with a sell on Great Portland Estates. It faces direct, permanent disruption risk from rising efficiency.
Okay, so if AI is the structural trend for computation, let's move to the other major theme, electrification. This is about watts and electrons.
And this is really framed as the theme of the decade. The scale is just immense. Think about it, only 20% of the world's energy is electric today.
And that needs to get to 55 to 70% by 2050.
Just to meet zero carbon goals. The investment implications are huge.
The report highlights a stark regional divergence, though. Let's start with the U.S.
In the U.S., electricity demand is expected to grow at a robust 3% plus compound annual growth rate, and 80% of that growth is driven by data centers.
So much demand that prices have to go up.
They expect electricity prices to rise 20% higher than what forward prices are currently indicating. So this makes U.S. independent power producers, names like Vistra and NRG, key focuses.
And then you contrast that with Europe.
It's a completely different picture. European electricity consumption is still languishing 4% below pre-COVID levels.
Just because prices have been so high.
Exactly. High prices,
Yeah.
reduced industrial activity. But the forecast is for those prices to fall, partly due to government charges being cut, and, critically, a forecasted 15% reduction in LNG prices in 2026.
So in terms of how to play this theme, where does the report point us?
To transmission and distribution, or T&D. It's a crucial bottleneck. Investment is absolutely essential, especially in Europe, where 40% of the grid is over 40 years old.
And that points to specific companies.
Yes, preferred exposure is through European T&D companies like Alia and Redia.
There's also a really interesting valuation point in the capital goods space, isn't there?
There is. This is a unique entry point. Capital goods stocks tied to electrification have seen their PE relatives fall or derate back to pre-gen AI levels.
What does that signal?
It suggests the market is no longer discounting a major cyclical improvement, even though the structural tailwinds are very strong. You get structural growth, but at a cyclically fair valuation. A name like Prysmian, the subsea cable leader, is favored here.
Let's shift gears now to more tactical opportunities.
Right.
Let's look at the European consumer. UBS is expecting a positive surprise here.
Yes, a genuine positive surprise versus the consensus view of just 1.3% consumption growth.
And what's driving that call?
It's really three powerful drivers coming together. First, you have sustained 1.2% real wage growth. Second, the savings ratio is still high, about 3% above pre-COVID norms, so there's dry powder.
And the third driver?
The forecasted 20% fall in the gas price in 2026, that acts as a significant tax cut for the average household.
So, real discretionary spending potential. And how do they recommend getting exposure?
Through a few areas. Consumer-based hotels like Accor, budget airlines, especially Ryanair, and fast retailing, where Inditex is a favored name.
Okay, let's also talk about financials. The report maintains an overweight stance on banks for a third consecutive year.
It does, which suggests a deep structural belief in the sector's recovery, particularly in Europe and Japan.
Let's focus on European banks. Why the continued conviction? It's been a tough trade for a long time.
The conviction comes from a lot of macro factors finally aligning. You have strong macro, very low private sector leverage, and improving fundamentals. And crucially, they benefit from that rising bond yield we mentioned.
You're right, which helps net interest margins.
Exactly. Plus, you have AI as a significant internal cost-saving lever. McKinsey forecasts 15 to 20% lower costs are achievable.
And what about the call on Japanese banks? It feels more strategic.
It is. It's positioned as an important structural hedge against a carry trade unwind scenario.
Meaning a scenario where the yen rapidly strengthens.
Precisely. Japanese banks offer resilience and a buffer against that potential volatility.
All right, let's move to the defensive side of that barbell. Given that many cyclicals look stretched, UBS recommends selectively buying defensive. Where are the pockets of value?
The goal here is to find defensives that are both cheap and where, disruption fears might be exaggerated. Global household products fit that profile quite well.
How so?
Well, they rank as the second cheapest sector globally, trading at 17.9 times forward earnings. And importantly, they're seen as one of the least disrupted staples.
Meaning low risk from things like weight loss drugs or changing health trends.
Exactly. And they have high emerging market exposure, over 40%. Reckitt Benckiser is a highlighted name here.
Healthcare equipment also screens very well.
Exceptionally well on quality and growth.
Yeah.
And the valuation is at a level that has historically resulted in outperformance 71% of the time on a 12-month view.
That's a strong statistical argument. What about regulatory risk?
The report notes that the impact from U.S. healthcare reform, the OBBBA, is expected to be minimal on hospital spending until late 2027 or 2028.
So there's a clear runway.
A clear runway. They prefer names with low China risk like Abbott or high copay exposure like Alcon.
The report also calls out a valuation anomaly in flavoring companies.
It does. Companies like Novonesis, they created an 8% PE discount to the broader staples sector even though they have superior volume growth.
So why the discount? Disruption fears?
Yes, disruption fears around unhealthy ingredients. But UBS argues these are exaggerated. Most of these companies have small U.S. exposure, and more importantly, they can reformulate their products. So Novonesis is a preferred play there.
Okay, now we have to turn to commodities. This is a fascinating split, a very strong buy on gold, but general caution on industrial metals.
It is. And the gold thesis is maybe the most unconventional call in the whole report. They're forecasting $400, $750 an ounce in Q2 2026.
$4,750. What is behind that number?
It's based on the idea that gold has completely decoupled from conventional macro models. It's no longer just moving based on the dollar or interest rates.
So the drivers are more structural?
Purely structural and, you could say, existential. Gold stocks are still abnormally cheap, pricing in only about $3,700 an ounce.
So the market is skeptical. But what's the fundamental driver?
It's rooted in sovereign debt risk.
Yeah.
UBS assigns a 60% chance of either sovereign downgrades in developed markets or outright debt monetization.
That's a profound shift in risk perception.
It is. And the geopolitical landscape supports it. Emerging market central banks are expected to dramatically increase their gold holdings due to sanction risk and the extreme U.S. net foreign debt position. Gold is the ultimate insurance policy.
A stark contrast to their view on industrial commodities. Why the caution there?
The near-term caution is macro. Global industrial production needs to be above 3% for prices to rise. UBS forecasts 3.4%, but there's an inventory overhang.
And the bigger, longer-term headwind?
It's structural. It's China's pivot from investment-led to consumption-led growth. This is a huge negative for industrial metals, since China accounts for 58% of global copper demand.
So how should one navigate this sector?
Selectively. They have a benchmark rating on copper, acknowledging the structural story, but they caution that copper stocks are already pricing in a supercycle.
So the better way to get exposure
is through mining equipment companies. Names like Metso and Weir, they have high gold and copper exposure in their backlogs, but trade at much more reasonable multiples.
Let's bring it all together and synthesize the major risks for 2026.
Right, because any positive view needs disciplined risk mitigation. I group them into 3 categories.
Okay, what's the first?
Valuation and crowding. We've mentioned cyclicals in Europe are stretched, and defense stocks, which UBS downgraded, are flagged as highly crowded. Any bad news there could trigger a very rapid correction.
Second is AI disruption risk, and not just for the losers.
No, this is systemic. It's about the deflationary pressure on legacy business models. They highlight severe price deflation, up to 35% in IT services, and systemic threats to online advertising and software.
And the third risk category?
Policy and macro uncertainty. It remains high. The fiscal position of the U.S. government threatens healthcare costs, and China's industrial pivot creates persistent uncertainty for commodities.
So to summarize, what does this market of two halves look like for someone trying to stay well-informed?
I think 2026 requires a really high degree of selectivity. The strategic recommendation is that barbell, balancing exposure to high-growth structural trends, so AI and electrification, with late-cycle defensive positioning that's backed by compelling valuation arguments.
So neutrally framed. Opportunity exists, but it demands very careful risk management.
Exactly. Careful mitigation against stretched cyclical multiples, and of course, technological disruption.
This brings us to a final provocative thought for you to consider. Given the increasing risks of sovereign debt monetization that underpin that powerful gold thesis, and the implied breakdown of conventional macro correlations, what established financial relationship or valuation anchor should professional investors critically stress test next? Food for thought as you navigate the coming year.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.